Hello, welcome back. I hope you had a great week. If you are new here, I am Jessica Abella. I have been a tax advisor for nearly 30 years now. And today we are going to chat about emergency funds and perhaps some tax-effective ways to access cash when you're in an emergency situation. So we're going to start with the basics, really, the same advice that any financial advisor would tell you, and that is prevention of needing emergency cash, having that emergency fund already saved up and tucked away and ready to access when you need it. Recommendations are generally to have 3 to 6 months expenses set aside and available, and that's true both at the personal level, but also at the business level. So if you're at a business owner, make sure that you're keeping that in mind as you're allocating cash in your business as well. And of course, the first step to that is knowing what your expenses are. So making sure that you have an idea of what you're spending on a monthly basis, again, both from a business perspective and personally. Those funds can be sitting in a savings account, in a money market, in a CD, preferably not a long-term CD, but even long-term you can have an emergency distribution from and just not receive all the interest. They say that there's a penalty. It's really just not receiving all of the interest that you would receive if it stayed in the CD for the full term. If you don't have an emergency fund right now at all, just start small. Start putting something aside into an extra account to start building that up. Anything is better than nothing. So maybe you've exhausted all of your emergency funds and you still need funds. So let's talk about some options. Let's talk about disasters first. So if there is a presidentially declared disaster area, in our area that could be wildfires, in other areas of the country, maybe hurricanes, tornadoes, those sorts of things, there are some provisions that kick in to help mitigate the cost of these disasters. Your reimbursement from your insurance company is not going to be taxable unless they somehow reimburse you more than the loss that you incurred. Withdrawals from retirement plans may be exempt from the 10% penalty, and you may be able to stretch those distributions out on your tax return over 3 years instead of paying tax on all of it in 1 year. If you receive disaster relief payments from somewhere, those payments are not taxable. And there's a casualty loss deduction available on your tax return, and for these presidentially declared disaster areas, that loss can be claimed on the prior year's tax return just so that you can get that request in and get funds back faster. Let's hope that you're not in a presidentially declared disaster area, and let's talk about some other options that you may have available. If you are in a hardship situation, you may be able to take a distribution from your 401k account, assuming that that is an option with that 401k. Note, though, that those distributions are still taxable and they're still subject to a 10% penalty if you're under age 59 and a half. Taking a loan from your 401k could be a much better option. It gives you the opportunity to pay it back. Just keep in mind that if you leave that employer, you may receive a 1099 showing that the remainder of that outstanding loan is taxable to you in that year. So be aware of that. You might end up paying tax on those funds after all. And sometimes much, much later than you took the funds out. With an IRA account, there is a 60-day rollover rule. So if you just have a really short-term need and you are absolutely certain you're going to be able to put the money back, you can withdraw money from an IRA and put it back within 60 days and not pay tax on that transaction. It's really not something that we would recommend. And it's something that you have to be really, really careful to get the funds back in and credited to the account within that 60 days. Really important. If you have an equity line of credit on your home, that is a great option. Note that with current tax law, when you're using those funds for something that isn't the house, the interest would not be tax deductible, but still it's a good way to access funds. Cashing out investments is another great way to get some cash when you need it. There are a few days that it takes to sell stuff and to get the cash back out of your investment account. But a couple of considerations for that. Keep in mind that the profit or loss on anything that you sold in order to free up cash would be taxable on your tax return that year. Keep in mind that while long-term gain is taxed at a lower rate, it's not always the best option to sell that longest term stock or mutual fund. You may have some funds in your account that maybe are short term but have very little profit or maybe a loss, and selling those may be a better option from a tax perspective. Granted, I'm not a financial advisor. I can't tell you if this stock or that stock is better to sell from a investment perspective, but from a tax perspective, don't feel like you have to sell that long-term gain to get the best tax benefit. It may be best to sell some short-term stock or look for some losses to offset the gains. Definitely working with your tax pro and your financial advisor together can always be a great option. So these were some options for accessing some cash along with the tax implications. Is there anything that I missed? Any questions that you'd like to have answered, or anything that you think that we should address in a future video? I would love to hear your ideas and your questions. Also, please subscribe if this was helpful to you. Click like, share with someone else, and I hope that you have a wonderful week, and we'll see you again next week.